Bismillahirrahmanirrahim. Subject is financial statement analysis. This is 8th online lecture, and today we will discuss market ratios in financial statement analysis. The lecture agenda for today lecture is we will discuss market ratio. We will discuss market ratios formula, and then we will explain these market ratios with the help of numerical illustrations. Then along with numerical calculation of market ratio, we will also get how to discuss and interpret these market ratios. So what are market ratios? Market ratios are those ratios which are used to evaluate the stock price or share price of those shares which are publicly held by investors. Secondly, these ratios are used by current investors, those people who have already invested in these stocks, and those investors who will potentially or who will invest in the stock of the company in near future. What they are going to evaluate in market ratio, that whether the company share are overpriced or underpriced. In case of overpriced, oftenly investors start selling the shares. In case of underpriced, these investors start invested in the stock of the companies. Secondly, market ratios measures what it measures: investor response to owning the company stock and also the cost of issuing a stock. These are concerned with return on investment for shareholders. These ratios also calculate return on investment for the current shareholder, and with the relationship between return and value of investment. It means if the share price gives higher returns, what's this higher returns have impact on the value of the shares. The market ratio also discuss this relationship between return that is provided by the shares to investor, and second is value of the shares. So what is the relationship between return and value of the share will also be discussed in market ratio. Third, one should always consider various factors. What are these factors when we are going to consider, or when you're going to analyze the market ratios? Including range of market value ratios. On single ratios, investors should not make a decision. They should calculate range of market value ratios. What it means range? You may calculate it for quarterly, you may calculate it for half annually, you may calculate it for 1 year, or you may calculate it for daily as well. So what are market ratio? Different authors have included different market ratios in their books, but we will discuss some important market ratios in this lectures. We will discuss one by one. What is earning per shares? Earning per share is calculated that net income divided by total share outstanding shares, means how much the company earns during the year for 1 shares. If you have, let's suppose if an investor have 1 shares, how much 1 shares, how much this 1 share have its portion in the net income of the company, it is called earning per share. So we calculate his net income divided by our total outstanding shares of the company give us earning per share. Dividend payout ratio, if the company, let's suppose, earn 10 rupees per share and it gives 3 rupees as a dividend. What is dividend payout ratio means? This 3 divided by 10. We say that 30% is dividend payout ratio. Again, if a company earns 10 rupees on 1 shares, 10 rupees per share, earning per share is means 10 rupees, and the company announce 3 rupees dividend per share. Per share means if anybody hold 1 share, he will get 3 rupees. So this 3 rupees is dividend on each share. So 3 divided by total earning is, it becomes 30% dividend payout ratio. Now book value per shares. Book value means the company equity have equity sections. Now it increase outstanding shares, it include outstanding share, it include retained earnings, it include reserves, it include premium. All these things constitute one figure which we call book value of the equity. Now book value per share means this total value of the this portion of the balance sheet divided by outstanding share is called book value per share. Market to book value, when we calculate book value, then we will compare it with market value, that is quoted on the stock exchange, divided by book value, it is called market to book ratios. Price earning ratio or PE ratio means market price of the company divided by earning per shares. It is called market price earning ratio. Dividend yield ratio. Let's suppose if you invest 100 rupees in any company and it gave you, let's suppose, 5 rupees dividend per, and you hold the shares for 1 year and you receive 5 rupees dividend. It means 5 divided by 100, the share provides 5% dividend ratio. 5% dividend ratio or dividend yield ratio. Now we will discuss each one in detail. Earning per shares. Earning per share is measures the company net income per share of outstanding stock, indicating that the company's profitability to investor on each share they hold. Earning per share can be calculated when the company earnings, mean net income, when divided the company net income by total number of outstanding share, we get earning per share. So earning per share is equal to net income minus preferred dividend. Means this net income when the company paid dividend to preferred shareholders, the remaining amount left for these common shareholders. So net income minus preferred dividend, what left will be divided by year-end outstanding shares. What it means? It means that net income when reduced by preferred dividend, what is left for the common shareholder, will be divided by year-end outstanding common shares. We can refine this ratio by this outstanding share can be increased by when there is an option to the managers, options to the employees to avail common shares, to avail option to have common share in the company. Sometimes we have convertible debt, and when the bondholder convert this debt into shares, so this number of share will be increased. Sometimes we have a warrants when it converts into common shares, we can this earning per share can also be changed. So this earning per share can be refined by these option conversion into common share, convertible debt when converted into common share, or warrants. So this ratios can be refined in this way. Earning per share examples. During 2019, XYZ Limited has net income of 1 million rupees and preferred dividend for the year is 200 million rupees. Outstanding share for the year remain 400 million common shares. What is earning per shares? We will plugging the values from this examples into the following formula. Earning per share is equal to net income minus preferred dividend divided by year-end outstanding shares. So earning per share is equal to 1000 is this net income, and 200 is this preferred dividend divided by 400 million is common shares. So earning per share is 2 rupees per share for the company. It means that rupees 2 is available to a common shareholder, potentially one occurrent after fulfilling all the expenses of all stakeholders. What is dividend payout ratio? Dividend payout ratio is the ratio of the total amount of dividend paid out to shareholder relative to the net income of the company. It is a percentage of earning paid to shareholder in dividends. It can be calculated as dividend payout ratio is equal to dividend paid divided by net income available to a common shareholders, or it can be as dividend per shares if we have divided by earning per shares. If we can get this amount from the balance sheets as well as net income. Secondly, if we have already calculated dividend per shares or earning per shares, we will use this formula. Mostly in practice, dividend per share divided by earning per share calculation is done for 1 shares. Even we can do a calculation for the all outstanding shares. Dividend payout ratio provides or indicate that how much money of the company is returning to shareholder versus how much is keeping in hand to reinvest in growth, pay off debt, and add to cash reserves or retained earnings. That means we have a net income. Let's suppose this net income can be consumed in three ways: dividend to the shareholder, secondly for the growth purposes, or third to keep it as reserves. So dividend payout ratio indicate that how much in percentage the net income is returning to the shareholders. Dividend payout ratio example. Suppose XYZ Limited that paid total 5 million dividend last year and it has 5 million share outstanding. Suppose that company had net income of 50 million last year. What is a dividend in payout ratio? That is dividend 5 million to all shareholder, 50 million is net income. So how we will calculate? We will plug in the values from the above examples in the below formula. Dividend payout ratio is equal to dividend paid divided by net income. So dividend payout ratio is equal to 5 million, that is dividend paid, divided by 50 million, which is equal to 0.10 or 10%. This 5 million is dividend paid. This 50 million is net income. So 10%, this 10% means the company returning 10% of its earning to the shareholder as a dividend, or giving them 10% in the profit to the shareholders. Moving further, book value per share. What is book value per shares? I have give brief introduction in the earlier of this lecture. That is book value of the equity per share is the ratio of equity available to common shareholders divided by number of outstanding shares. Book value is equal to total equity minus preferred shares divided by total outstanding shares. Book value of the equity is per share is a measurement can be used by investigator to gauge whether the stock price is undervalued by comparing it with the firm's market value. If the firm market value and book value are same, you will say that neither undervalued nor overvalued. If market price is higher than the book value, mean if it is greater than 1, it means the company shares are overvalued. If market to book value is less than 1, it means that it is undervalued. If a company book value per share is higher than market value per share, its current stock price, then the stock is considered undervalued. If the firm's book value per share increases, the stock should be perceived as more valuable and the stock price should increase. Now book value per share example, XYZ Manufacturing common equity balance is 10 million and that 1 million share of outstanding. Calculate book value. We will put the value in the below formula from the above example as book value per share is equal to total equity minus preferred shares divided by total outstanding shares. So book value per share is equal to $10 million and 0. Why it is 0? Because there is no preferred shares, divided by 1 million outstanding shares. So book value is equal to 10 per shares. This means the common shareholder will receive $10 per shares in case of liquidation. This is also show that company value according to its record is 10 per shares. Means the book of the company balance sheet shows that the company one share price or one share value is $10 per shares. In other words, if the company goes bankrupt or liquidated, after fulfilling the claim of all stakeholders, the common shareholder will receive $10 per shares. Market to book value of the company. Market to book value ratio is called price to book ratios. It is financial valuation measurement to evaluate the company's current market relative to its book value. Market to book ratio indicate that the company is undervalued or overvalued. As I told you earlier, if the market value is higher than book value, the ratio will be greater than 1. In this case, it indicates that the market overvalued the share of the companies and investors who come to know that the market has already overvalued the share of any company, they will start selling it. If the market to book ratio is less than 1, it means that the book value is higher and market value is lower. It means that the market investors undervalued this market to book the stock of the company. So potential investor will start investing in such shares and the market value goes up. Now, market to book value is equal to market capitalization divided by total book value of the company. The market value is the current stock price outstanding shares, the price that the market believes the company is worth. In open market, such as in stock exchanges, what is the value of the company is called market value of the company. The book value equals to net assets of the companies and come from the balance sheets. Secondly, what is book value? What we have recorded in the book, it includes, as I told you earlier, common shares, then retained earnings, then reserves, if any. So book value consists of these but not limited to it. It may include more figure. But common shares, retained earnings and reserves constitute the book value of the common equity. A low ratio less than 1 could indicate that the stock is undervalued or bad investment. And higher ratios greater than 1 could mean that the stock is overvalued. It has performed well. Now, market to book value ratio examples. Let's suppose ABC Limited had 100 million rupees in assets, the balance sheet, and 750 millions in liabilities. The big book value of the company, of that company, would be calculated simply as 250 million, since 1000 million is its assets and 750 million is its liability. So the net worth is of the company is a book value of the net worth of the company in the book of account is 250 million. If there is 100 million share outstanding, each share would represent 25 of book value. How 25, this 250 million shares, this 250 million rupees value will be divided by 10 million outstanding shares. 10 million, it's cross cancel, so 25 rupees per share is the value of the company, book value of the company. If the share price is 50 rupees in the open market or on stock exchange, what is the market to book ratios? Plugging value in below formula to get market to book ratios or price to book ratio, we get market to book ratio is equal to market capitalization divided by total book value. So market capitalization or market price of the one share is got 5 million divided by 250 million, which is, sorry, this is a typo, it is not 25 million, it is 250 million, so which will be equal to 2 times. So it communicates that the market value of the firm is twice its book value. So the investor overvalued the share of their ABC Limited. Means the company performed well in the past, and that's why the shareholder preferred to invest in the ABC Limited shares, and its market price move upward. So that is the reason of the overvaluation of the company. Price earning ratio. Price earning ratios is the ratio for valuing the company that measures its current share price relative to its earning per share earning or earning per shares. The price to earning ratio is also some time known as price multiple or the earning multiple. Now earning per share is equal to market value per share divided by earning per shares. High price earning ratios could mean that the company's stock is overvalued, or else that investors are expecting high growth rate in the future. So there are, when we can infer two things. If we have high price earning ratios, the stock is overvalued, or the investor expecting that the company will grow in the future. That's why its market value is higher as compared to its earning per shares. Because if price earning ratio is higher, it means that it have lower earning per share. If the company have low earning per share, how investor can invest in that in this shares? There are two reasons. Because of the market sentiment, the investor overvalued it. without considering the earning per share. Or secondly, if these investor may consider that the company may have a high growth as compared to its peer, that's why its market value of the share is higher and investor valued it. Analyst and investor review the company's price earning ratio when they determine if the share price accurately represents the projected earning per shares. Price earning ratio means that projected earning per share or earning per share in the future will accurate this price earning ratio. So that's why they value the companies higher as compared to its peers. Price earning ratio example: WMI companies stock price closed at rupees 910. That is the stock price of the company. The company profit for the fiscal year June 30th is 130 billion rupees and its number of shares outstanding is 30.1 billion. Earning per share can be calculated as 130.64 billion divided by 3.1 billion. Now 42 is basically earning per share. What is price earning ratios? Now price in the market is 910. We will plug the value in the below formula. Price earning ratio is equal to market value per shares, which is 910 divided by earning per share, which is 42.14. Now we plug the values. 910 divided by 42.14 is equal to 21.6 times. High price earnings suggest that investors are expecting higher earnings growth in the future compared to the company with lower price earning ratio. This shows that the investor is expecting high earning growth in WMI company. Dividend yield ratios. Dividend yield ratio expressed is a percentage is a financial ratios dividend divided by market price. It shows that how much the company pays out of in dividend each year relative to its stock price. Dividend yield ratio, dividend per shares divided by price per shares, market price per shares. So dividend yield displayed, what it indicates is a percentage is the amount of money company pays to the shareholder for owning a share of its stock divided by current stock price. It means if a person invests 100 rupees in any companies for a whole year and it get 5 rupees as a dividend, it means at 100 rupee yield only 5%. It is important for investor to keep in mind that higher dividend yield do not always indicate attractive investment opportunity, because dividend yield of the stock may be evaluated as a result of declining stock prices. There are two things. High dividend may be because it might be because of this denominator. If any company have declining stock price, its dividend yield ratios might be high. If it is not because of this dividend per share increases, then it is a positive sign. Examples of dividend yield ratio. Suppose the company declare a dividend of $1.7 per share. The par value of the share of the company is $15 and market price is $20. What is dividend yield? We will not use company's par value, which is book value. We will use for dividend yield the market value, which is $20. So putting values below formula, dividend yield ratio is equal to dividend per share divided by price per shares. So dividend price earning ratios 1.7 divided by $20, which is equal to 8.5%. So if, let's suppose, Mr. Z invested in this company for 1 year and held this hold this investment for 1 year, and at the last it get $1.7 per share. It means it gives 8.5% returns or dividend yield to this investors. Dividend yield ratio is 8.5. It means that investor would earn 8.5% on his investment in the form of dividend if he buys the company's common stock at a current market price. This is all about today's lecture. Thank you.